With us to talk all things market. Mark, great to have you with us here. Thank you very much. You know, on the S&P, we are again back over the last 2 days quite aggressively. Not overnight was still mild, but the day before, on Wednesday, the U.S. market sold off aggressively. Are we starting a fresh leg down?
I don't think so. I don't see why. To my mind, we have a earnings forecast this year, which is easy to beat. The consensus is only looking for 2% earnings growth this year. We have inflation, which is clearly rolling over and on its way down. And the biggest reason the markets went down last year was because of the higher interest rates that were prompted by inflation. And yes, the economy will slow down as a function of those higher rates, but to my mind, if there's a recession, it will be only a technical one, and you'll barely feel it. I mean, the difference between minus 0.5 and plus 0.5 GDP growth is very small, and so I don't think the market should sell off a lot.
Okay, you don't think the market should sell off a lot. Mark, good morning. What about India? Despite all the weak global cues, the Indian markets are quite resilient. What have you made of the earnings season so far, and how are you approaching the markets, say, in the second quartile of the year?
I also think it's fine. By the way, I forgot to say that I do think that the interest now is clearly more in bonds than in stocks in the United States, and so that would be reflected internationally as well. And investment-grade bonds year-to-date are up about 4.5%. High-yield bonds are up about 3.5%. So bonds are doing better than stocks, and I think that's because people can see that inflation's coming down, and therefore interest rates will follow, the 10-year back at 3.4. And where that leaves India, I don't think it's a bad place, because the dollar is also softening as these interest rates come down. And I saw an interesting chart the other day of the leadership in the S&P throughout the decades. Usually one sector will lead the market for a few years in a row. Just like you'll remember, the last 10 years was all about technology. Well, in the 2000s, in the aftermath of the dot-com bubble collapse, there was no strong leadership in the S&P, and actually it wasn't a very good decade for the US market. It was a very good decade for emerging markets. And just like back in 2001 or 2002, I don't think anybody could have seen that about to happen. If you'd gone back 20 years, I don't think anybody would have believed that the 2000s were going to be such a great decade for emerging markets. So I think they have a lot of potential now. And of course, India is an emerging market. And I think it'll do just fine this year.
All right, Mark, we have the Fed meet that's coming up. What are you penciling in? Earlier we were working with around 50 basis points, but gradually as the weeks progressed, it appears now the expectation is 25 basis points. What's your sense? 25
basis points, and that's it. I don't even think they need to raise, but I think it's sort of a face-saving thing because they've been so committed to raising rates. It would look a bit odd if they didn't do it one last time. But after that, we don't see any more because we just don't see the reason. And if you extrapolate the sequential change in inflation over the last 2 months, which has been 0.1% month on month, we should get to about 2.5% year-on-year inflation in May. And that, I think, is a good level. So the commodity prices are soft and property prices in the United States are soft. There's absolutely no reason why inflation should not continue to fall. So, yeah, the last one, February 1st, and I think that's why the 10-year Treasury is at 3.4%, because the market can see that.
At some point, as you say, and you say it will be Feb and one and done, basically, in terms of rate hike. And a very brief answer to what is a question which perhaps requires a very long explanation, but we don't have the time. But I want to ask this: do you think rates will go back to very low interest rates in 23 or 24 or 25, or you think we're going to now see a more orthodox monetary policy globally?
Yeah, more orthodox, thank goodness, because the last 10 years, unorthodox monetary policy created a lot of bubbles and things that shouldn't have happened. But the most important thing, may I say, is the fact the 2-year Treasury note has peaked. The yield on the 2-year Treasury note has peaked, and that always led the last rate hike by about 3 to 4 weeks. So that, I think, is the real canary in the coal mine, and has indeed peaked and rolled over.
All right. And more orthodox monetary policy basically means real positive rates, right? If not,
yes, then thank goodness,
more.
because you
At
should
least.
have to borrow, pay
Yeah.
when you borrow money. Yeah.
All right. Thank you very much. Great speaking with you, Mark. Have a great weekend, and we'll see you back soon again. Thanks indeed. We'll take a very quick break here. What we'll do is we'll come back with our research team, our top stocks to watch out for lined up next. Stay with us.